Hello, people. Dr. Wang is here. Today we are going over this new chapter, the cost of capital, and we have a different subtopics here, and we're gonna go over each of them. First of all, we need to get an idea of the financial markets. This is basically from your chapter two, which we skipped for the first half of the semester. So we need to know how the cash would flow among different parties in the entire business society. So you have a company here that is made of the current assets or short-term assets. We're talking about inventory, account receivables, and cash. It also made of fixed assets, which is long-term assets. So you have property, plants, equipment, and all stuff. Okay, and then on the financial market, you will have short-term debts, long-term debt, and equity shares being issued by the firm. And the firm basically sell their securities, okay, in the form of this to raise money, okay? And there are investors in the financial security, and if you are an investor and you buy short-term debt of the firm, so basically you are providing cash to the firm. So this green arrow basically tells you the money is flowing from the financial markets to the firm. So the firm, by issuing securities, raise capital. After the firm get capital, they would invest in assets and they would invest the money in its operations, enlarge the scale of business, and then the firm makes more money. Okay, and then the cash would flow all the way back to of course, you need to pay taxes to the government. There are only two things you cannot avoid in your whole life. One is a tax, and another is death. All right, and then after you pay a fair amount to the government, you will pay your investors. Okay, if you pay the equity investors or stock buyers, you are paying in the form of dividends. And if you are paying the debt investors or notes investors, you are paying the form of an interest or a corporate coupon or face value of the bond. Okay, and also the firm can decide to retain part of its profits and save the money for its future uses. Okay, those will be called retained cash flows. All right, and what kind of capital do firm use? So as I mentioned earlier, you have a short-term debts and long-term debts. So if it's a short-term, we call it notes payable. If it is long-term, we just call it corporate bond, bank loans, and private placement of loans. I have written a paper with my co-author from University of North Carolina and Kent State University. We got to an idea of the different kind of long-term debt what it would create on the company's bankruptcy probability. Okay, so just want to mention that, and also the capital for the equity part. We have a preferred equity and we have common equity. And for preferred equity, or you can also call it preferred stock, if you invest in that, your payment is almost guaranteed. So you get a fixed amount of a dividend paid to you as a preferred shareholder. And Warren Buffett is a famous investor in preferred equity shares. Okay, and also most commonly you have a common equity or common stocks, and this is usually from a company's initial public offering, and you can buy the company new common stock. If you're an investor of the stock, basically you put your money in the capital in the firm, and then the firm will use your money for its growth. And also, if the firm makes net profit, we're talking about net income. We're not talking about operating profit or gross profit. This is coming from net income. And the net income belongs to all of net income belongs to the shareholders. And part of net income can be retained by the firm or saved by the firm for future development. Okay, on the canvas, if you look at the module, if you look at chapter 9, I have put one external video link shows you how the stock market works. Okay, and on the company's financial statement, you have this balance sheet, and you have this oops, okay, long-term liabilities. Okay, that's long-term debt, and you also have this stockholders' equity. That's from stock issuance. Okay, so the capital will be reflected here. All right, if you make a comparison of a stock and bonds or equity and a debt, so they have a different characteristics, and this is something you need to know, and you will be tested in your final exam. This could be a multiple choice or conceptual question. First of all, if you are an equity investor, you basically are buying the firm's ownership. If you're just a debt investor, you simply lend money to the firm. So if you're an equity investor, you own the firm. No matter how small share you own it, you are an owner. But if you're a debt investor, no matter how much money, how large amount of debt you hold, you are still not owning the company. Okay, and then if you're an owner of the company, you can see that a common stockholder can vote for the firm. They can select the board of directors through a democratic way and decide other major issues. Okay, but if you're a debt investor, of course you're a creditor, but you do not have the voting right. Okay, and if you are a debt investor, you get paid by interest, and the interest is paid before tax is paid. Since it's the before tax, interest payment is tax deductible at the firm's perspective. Okay, and the dividends on the other side is paid after tax is already paid, so it's not tax deductible. Right? You know where dividend come from? Come from net income. And net income is after tax. And also, creditors have legal recourse if interest or principal payments are missed. So basically, if you are a debt investor, you sign a contract, you sign an agreement with the firm. If the firm does not pay you interest or principal, you can sue the company. Okay, so by law, they always have to pay you the interest and the principal back unless they get bankrupt. But if you're an equity investor, that's a different story. The firm is not obligated to pay you dividends. Okay, so if they missed any dividend payment to you, there's no action you can take. All right, and also higher amount of debt can lead the firm to financial distress or even bankruptcy. Again, the definition of bankruptcy is a firm's inability to pay back its obligations. Okay, if you're running an all-equity firm, you cannot go bankrupt. If you keep losing money, you just run negative equity, and that's it. All right, and we also have this hybrid form of a capital. We call it preferred equity. And preferred equity, it is an equity for sure because it indicates ownership. But it also has a certain characteristic that is similar with bond. So if we look at the preferred equity, they got a priority in terms of getting dividends. So when the firm makes a profit, the first party getting paid is the bondholders, and then the preferred equity holders get paid second, then the common equity holders get paid last. Okay, and if you're a preferred holder, your dividend is usually fixed. Okay, there's no risk of getting unstable dividend. And also in the event of liquidation, if the firm wants to be sold or liquidated, then the preferred stockholders would get paid first. And also, you can demote your preferred shares to common stock shares. Why do you want to demote your shares? Because you want to vote for the company. Okay, so if you hold the preferred equity, there's no voting right. Okay, there's no voting right, but you can get the voting right by convert your preferred shares to common shares. Okay, and usually a lot of people say preferred equity is a debt in disguise, but it's not really a debt. If you compare preferred with corporate bonds, there's no guarantee of payments. Okay, although you should get a fixed amount of dividends, but the firm, if the firm does not make money, they just don't pay your dividend. Okay, and there's no way you can take action about it. And also, it is subordinate to bonds in the terms of a cash claim and liquidated assets. So far, you should know the pecking order of a cash claim rights. So on the top of the food chain, you have the bondholders, okay, bondholders, and then you have a preferred stockholders, okay, and then you have a common stockholders. Okay, the bond is a little bit narrow. So the debt can also be in the form of bank loans or private debt. So let me just put it as debt. Okay. So the debt holders get paid first, second preferred, third common. Okay. This is in the event of liquidation if the firm gets sold off, or this pecking order is also followed when the firm distributed cash. So let me zoom out myself. Okay. So debt is first, preferred second, common is last. All right, and then in terms of, so So in terms of risk level, if you are a debt investor, your investment is the safest. Okay, so of course, we look at different dimensions. So we look at cash claim. Okay, so cash claim can be divided into income distribution and also liquidation. Okay. All right, and also you have another dimension that this pecking order would apply, and that is safety. Okay, safety. Okay, or riskiness. Okay, riskiness. So the debt holder's investment is the safest or has the lowest amount of risk. Okay, and followed by the preferred investors, it has a moderate risk, and the most risky would be common stock. Okay, the common stock investment would be most risky. So if you if this is a indication of a risk level, and also the returns, you can call it required returns, also follow this order. So the debt, because it's the safest, so it does not give you as high return as all the other investments. The preferred is safer than common, but it's less risk, but it's safer than common, but it's more risky than debt. So the return for preferred is in the middle. Okay, for common stock, it is the most risky assets, so the required return for common would be higher. Okay, so these are the dimensions you want to compare these three types of capital. You have a cash claim, income distribution, and liquidation, and you have a riskiness and return. All right, so that's the basic introduction and a comparison of these three types of capital. All right, and in this chapter, we are going over this formula. It is called a weighted average cost of capital. So assume a firm has all three forms of capital, and you want to know the overall cost to finance the firm, okay, combining all the three types. So you have a debt part, you have a preferred equity part, and you have a common equity part. Well, here is the notation is a little bit weird. It's just to follow the textbook. WCC is for common and S is for stock. All right, just to let you know. So this is for debt, this is for preferred, this is for common stock. And the W's, it refers to the capital's structure weights. And these weights are in percentage. Okay, be very careful. These are not dollar figures. These are percentage. And all the weights would add up to 100%. Okay, for example, this firm may have 50% debt and 50% equity. Okay, so that kind of story. You cannot put a $500,000 there for debt and $500,000 for equity. It just doesn't work that way. You have to use percentage. And the second, these R's are the returns for these securities of corporate bond or preferred stock or common stock. But in this new chapter, we are taking a different perspective. We treat those as a cost of a capital. Okay? So just to think about this, when you're an investor, okay, your money in the firm is called investment. Okay, that's your investment. But for the firm, when the firm gets money from you, the firm receives capital. And the firm has to pay money to the investors. Okay, to the investors, it's a return for their investment. But for the firm, it is a cost to raise capital. Does that make sense? So when the firm attracts capital from the financial market, the firm has to pay enough return to the investors, okay, in the form of dividends or in the form of interest and the principal. And all these payments to investors is a financial cost to the firm to raise the capital at the first place from the investors. Okay, so that's why it's called a cost of a capital. So we are talking about the same money, same percentage, but we just change our perspective and call it differently as cost of capital. Okay, the required return is to the investors, is cost of capital to the firm. All right, so if we look at the first part, the debt part, this is the debt part, and as I mentioned earlier, the debt payment, like interest, is before taxes paid. And right here, as an investor or as a firm manager, we care the after-tax term of the cost of capital. Okay, and we know the payment to the stock holders, no matter for preferred or for common, these are all come from net income, and the net income is already after tax. Okay, but since debt payment is before tax, so we have to multiply this one minus tax rate there, so we can put them on the same page as after tax cash flows. All right. Okay, and the implication is quite simple. So if the cost of debt is already 10% and the company's tax rate is 34%, so basically the company pays 10% as the interest. Okay, but the company would receive tax credit. Okay, more debt payment basically means you have a less taxable income and you pay less amount of tax. All right, so you receive a tax credit. And then your tax credit basically is 10% times tax rate of 34%. That is pretty common in the United States. And on a side note, I would say 34% is pretty high compared to all the developed countries in the world. Okay, so how are the weights determined? So we talk about all the W's. These are the weights. In Chapter 8, we also talk about those weights a little bit. So there are different value systems for the firm. You have a book value, which is determined by the financial statements. Like you look at the balance sheet, you see total liabilities, you see total equity, and this information is updated quarterly or annually. Okay, that's called a book value. And you also have a market value. And market value basically is the bond price or stock price in the secondary financial markets, which keep changing every second. Okay, and the book value are pretty easy to derive. So you just need to check the financial statements of the firm, and you can easily find the debt and equity and get risk analysis. And the market value is pretty hard to get because it keeps changing all the time, but it is more updated and it's consistent with the profitability of the firm because the market values are determined by the cash flows generated by the security. Okay, and the market value would be the market price of the stock times the number of shares of the stocks. You can apply the same formula for corporate bonds. The market price of the bond times units of insurance of the bond. All right, so now let me just talk about this homework. Okay, homework question 4. It tells you a lot of information about a company's capital structure. There's no preferred equity, so it's only debt and common equity. So the debt has a yield to maturity of 8%. That's your cost of a debt. And also the common equity has a return of 10%. You have a tax rate there. What I really want to stress here is to show you how to get the weights for the debt and for the stock, for the common stock. So right here, you have a $900 bond and 1 million of them, okay? So you can use the $900 times 1 million, you will get a $900 million for the debt market value for the firm, okay? And then right here, it tells you about a common stock, $10 per share, and you have a 10 million stock outstanding, okay? So use the 10 times the 10 million, so that's gonna give you 100 million, all right? So you have a 900 million for debt and 100 million for stock at the market value. You add them up. Okay, you add them up, it would give you $1 billion. You see 900 plus 100, that's 1,000. So it's gonna be $1 billion. And 900 million would be 90% of that $1 billion total assets. And $100 for the common stock would be 10% for the $1 billion market value of the entire firm. Okay, so the weights for debt is 90% and the weight of stock is 10%. And you have to show me the work. Okay, don't just put a 90% and 10%. All right, you have to show me all the work to get a full point. All right.